speaking, capital gain tax is a tax on the profit you make when you sell an asset for more than what you paid for it. For example, if you buy land for 10 million naira and you sell that land for 15 million naira, what you're going to pay the CGT on is the 5 million profit and not the value of the total assets. In Nigeria, at least to the end of this year, 31st December 2025, we pay a 10% flat rate on CGT. So for that 5 million naira profit, you're expected to pay 10% of that, which is 500,000 naira. However, with the new Tax Act, we are looking at a more progressive model where the rate of your CGT is going to be fixed on your personal or corporate income. So 2 words, fairness and arbitrage. Government is of the opinion that those who earn more should contribute more. Of course, a lot of tax professionals agree with this view. They think, why will profits realized from the sale of land, let's say in a highbrow area of Lagos, Banana Island, be the same with profits realized from a rural area? So government is looking to close this gap and ensure equity in our tax regime. Secondly, arbitrage. Corporations and individuals have known to disguise personal income as capital gains so that they can pay less tax. So if we fix our CGT rates to our personal and corporate income rates, government believes that this move can close the gap and block the loophole. So investors are affected in multiple ways. However, the new Tax Act has a lot of buffers, to cushion this impact. For example, if you do not meet the threshold of income and profit, you might even pay 0 CGT. Secondly, if you reinvest the gains you made, from shares in a Nigerian company, you might not pay CGT on those shares. A lot of other incentives that government have put forward to cushion the impact. But plainly speaking, and in a nutshell, small investors are largely shielded from the impact of this new regime. However, companies and individuals that realize a lot of profits would be the one to feel the impact more than others. So there is no global standard for CGT rates. However, Nigeria is not the only country rethinking its tax model. For example, the UK, they employ a progressive model which goes higher depending on what you earn and depending on property. In the US, the attention is really on the longevity of your investment. So if you're a patient investor, you are rewarded more, especially when you have long-term investments versus a short-term one. So while there's no global standard, Nigeria on its own is looking to attach its own tax model to developed countries where they employ a more progressive form of taxation. So critics of this new CGT regime have stated that this is a move for government to make more revenue of our capital gains. Well, yes and no. If we look at the revenue made from capital gains in 2024, government made about 50 plus billion from CGT. In comparison to CIT and VAT, that is company income tax and value-added tax that brought in tens of trillions of naira to the economy, the CGT is quite minuscule. So, of course, while government wants to make more from CGT, the overarching philosophy here is fairness as opposed to revenue. The big picture is that this reform is not just about numbers, but modernizing our tax framework, and it has to be balanced on 3 principles. 1, efficiency. 2, competition. And 3, fairness. Efficiency in the sense that we need to make compliance easy for stakeholders. Competition is that our reforms will still be attractive to both local and international investors and stakeholders so that they'll be able to compete fairly through incentives that can be gotten from exemptions and reinvestment opportunities. And fairness, small investors are protected while large investors, contribute fairly. If done right, these reforms will make Nigeria's tax system transparent and efficient. If done wrong, we have further complicated our tax regime. Efficiency is the key to performance in this instance. My name is Ekpo, Practice Manager, Xentia LP, and this is the big picture.